Hi, my name is MIRA SYAZANA binti SAMINGAN. I am 22 years old.
Hi everyone, my name is IZZATI and I am 22 years old.
Assalamualaikum and hi, my name is SITI NORAZEHA binti JUHARI and I am 21 years old.
Hello, my name is FARIS bin AHMAD KHIRUDDIN. I am 22 years old. So, hello everyone, I will briefly explain more on introduction of cost of capital and capital structure. So, capital structure is a sum of equity and debt finance to finance a company and its asset. So, different company has different capital structure as different company have different goals and objective, and there are situation where a firm might have all equity and no debt, and one more is a firm that prefer more debt over equity. So in terms of finance decision, uh, the weighted average cost of capital WACC uh, have a bigger impact to determine the capital structure. So the weighted average cost of capital determine the average cost of equity and also the cost of debt. So if a company want its capital structure to change, definitely the WACC also will change. In order to maximizing shareholder wealth, as we learn corporate finance, that we have to maximize the shareholder wealth. The ratio of debt and equity must be at the best, and calculating using what we learned in corporate finance, which is Miller and Modigliani assumption, where we will have to determine the higher value of levered firm can be. So in this group project, the situation given where ATC Berhad has experienced a bankruptcy and the current CEO, Mr. Han, is being cautious with debt financing. It is because in order to know whether the value of company can maximize shareholder wealth and the issuance of new bond will give benefit to the value and shareholder, we will determine it by discuss more on cost and capital and also capital structure of ATC Berhad. We will elaborate more on the calculation of cost of capital and also the optimal capital structure.
Hello everyone, my name is IZZATI binti and I will explain the answer for part A and part F. For part A, the sources of financing used by the company are equity financings and debt financings. So, what are the advantages and disadvantages of using these sources of financings? Okay, for equity financings, the advantages is free from any debt. ATC Berhad will not have to make any repayment on investment as they have no obligation to settle the interest to the bondholders. This will also create a less burden to the firm. The second advantages is follow-up funding. If the business of ATC Berhad is growing and develop well, then the investor will feel more confident and willing to provide more additional funds to the company. Move to the disadvantages of equity financing. The first one is share profit or ownership. As a return from their investment, investor might expect to get some of the profit. If they do not get this return, they might stop from making investment to the company of ATC Berhad and might invest it in somewhere else. But the second disadvantages is potential conflict. As a profit and ownership are shared with the investor, there will be different point of view and style on how to handle the company. Therefore, this will create the potential conflict. While for the debt financing, the first advantages is retain control. The lender has no authority to involve in controlling and running the company. It is the firm itself, which is ATC Berhad, which has the whole power to manage the company. The second advantage is there is a tax advantage. Interest on debts are deductible. While for the disadvantages, the first one, it requires payment. The firm might face a huge burden as there are debt needed to be paid in a time given. ATC Berhad need to make more cash inflow rather than cash outflow so that they can repay back their debt. For the second disadvantages is it can lead to bankruptcy. If a company is fully financed by the debt, the ATC Berhad might be in a high risk and lender will start to demand high level of return. This can lead to bankruptcy and financial distress.
For question B, we are required to compute the current WACC for ATC Berhad, as known as the WACC before the issuance of bonds. To calculate the WACC, we need two elements, that is cost of capital and weight of financing. We will start with cost of capital first. In this question, ATC Berhad only have cost of debt, which is bond, and cost of equity, which is shares. The cost of debt after tax has been given in the questions, which is 7%. So, we will proceed with the cost of equity. For cost of equity, we will use the internal cost of equity formula. As the formula stated here, the DO stands for last year dividend. The G stands for the growth rate, while P is the market price of the shares. Now, we will go to the calculation for the question. We had extracted the value according to the formula. In this question, ATC Berhad stated that the dividend paid out was 30 cents per share. That leads to the DO. And they expected the dividend growth at the constant rate of 4% per annum. So the 4% is the G, while the PO is 3 ringgit, as they stated that the current ex-dividend of ordinary share is 3 ringgit. We will key in all the value into the formula and we get the answer is 14.4%. So, with that, we know that the cost of debt is 7% and the cost of equity is 14.4%. Okay, we move on to the weight of financing. For the weight of financing, we need to find the value of the KE and KD, which stated that 360 million ringgit for equity and 72 million ringgit for the debt. Both of those values shall be divided by the total value of the capital, which is 432 million ringgit. And the answer of both WRF is 83.33% for the KE and 16.7% for the KD. Okay, we had completed the two elements, so we shall continue with the main questions, that is to compute the WACC. To calculate WACC, we need to multiply both of COC and WOF, and the result by multiplying both of this cost here, as you can see, is 12% for KE and 1.17% for the KD, which bring the result of WACC of 13.17%. Okay, we had compute the WACC before the new issuance of bonds. Now, we shall calculate the new WACC after the new issue of bonds, because we must compare both of them. For question C111, we shall first calculate the new cost of debt, because the changes is within the scope of debt only. In this formula, we shall find the net profit and the interest, because the bond is redeemable bond. So the net proceed formula will be the value of issuance minus the flotation cost. In this question, there is stated that there is no flotation cost and the bond is issued at the rate of 10% at premium, which will be multiplied with the nominal rate of 100, which the result is the net proceed will be 110 ringgit, while the interest formula is the interest rate multiplying by the par value. In this question, they stated that their interest is 8% and the par value is 100. So the interest will be at ringgit. So because the bond is redeemable, we have to work out with the internal rate of return of said cash flow, that is IRR. So to find the redeemable cost of debt, we must find the IRR that give NPV close to zero. In this question, we had decided to use 7% and 6% as our rate. So we had calculated for you in this table. As you can see, it shown that 7% and 6% is the rate that give NPV close to zero. That is negative 2.98 for 7% and 4.72 for 6%. With that, we can calculate the interpolation of IRR so that we can find the KD after tax. The formula is right here. As you can see, we must plus the positive NPV rate with the total of NPV positive value divided by the total of value positive and negative NPV. And lastly, we multiply with the difference of the rate. So we combine all the value that we have calculated earlier and it will give this slope. So press your calculator and the answer is 6.61%. Lastly, we shall complete it by multiplying with the tax to get the KD after tax. As you can see here, we had show the calculation for you, and the cost of new debt is 4.89%. For the new revised WACC will be shown in question C Roman 2. We had stated earlier that the step to calculate the WACC is we need two elements. So cut the chase, the COC of both debt and equity will be 4.89 and 14.4% as we calculate earlier. So we just need to find the WOF. Since there is a new issuance of bond, so the value of debt will increase from 72 million ringgit to 112 million ringgit. Then we divide both of the KE and the KD with the total of the value that is 472 million ringgit, which give us 72.27% for the KE and 23.73% for the KD. Thus, the WACC will be 10.98% for the KE and 1.16% for the KD. That brings us the total of 12.14% for the new WACC. Hi, it's me again. Based on our findings, we can see that ATC Berhad is a leverage company because they use both of debt and equity financing. So that we had calculated all the value earlier, we had combined in this table. As we can see that the cost of debt decreases from 7% to 4.89% and the cost of equity remain the same as there is no changes in the cost of equity. Also, the WSEC also decreased from 13.17% to 12.14%, which indicate that the lower WSEC will give rises on the company value. However, all changes has pros and cons in it. So, the disadvantages is the risk that the shareholder bond will increase due to increase in financial risk. In that case, ATC Berhad shall earn enough money in the new project so that the NPB will get positive result when discounted at the project specific discount rate.
Next, I will discuss question E1 and 2. Question E1 asks about opinion from viewpoint of traditional. In the traditional view of capital structure, there is non-linear relationship between the cost of equity and financial risk as measured by gearing. As company gears up by replacing expensive equity with cheaper debt, the WACC initially decreased. As equity investors start to respond to increasing financial risk, however, the cost of equity begins to increase until a point is reached where WACC starts to fall. This leads to an optimal capital structure where WACC is at minimum and thus the value of the company is at maximum. After this point, the ACC starts to increase as companies continues to gear up, rising more quickly at very high level of gearing up due to appearance of bankruptcy risk. Under traditional view, the director, Ms. K, might be correct in her belief that issuing traded bonds will decrease WACC depending on the position of the company relative to its optimal capital structure. For question E2, the question asks viewpoint from Monagny and Miller. Monagny and Miller showed that a perfect capital market without corporate taxes, the replacement equity with cheaper debt didn't lead to decrease in WACC since the effect of adding in cheaper debt was exactly offset by increase in cost of equity, which had linear relationship with financial risk. This means that the value of the company depend only on its business risk, not on financial risk. While if taxation is allowed, so that the cost of debt, which is steady after tax, is considered, replacing equity with debt lead to decrease in WACC because of the tax shield on profit gains by interest paid being allowable deduction in calculating tax liability. Under Monagny and Miller proposition to capital structure theory, gearing up as high as possible will maximize the value of the company. And the director, Ms. K, will be correct in her belief that issuing traded bonds will decrease WACC of ATC Berhad.
Okay, for E3, the market imperfection. So, as the finance director, Ms. K proposed to issue 40 million of bond to increase value of company while the assumption of decreasing the WACC. ATC Berhad also should not make debt finance as much as possible because the company is being cautious of the dangers of high gearing as the business has already experienced bankruptcy. And as for market imperfection, Miller and Modigliani assumed perfect capital market on capital structure included bankruptcy costs, agency costs, and also financial distress at high level of gearing. This will reverse tax shield as it will reduce and which make optimal capital structure where weighted average cost of capital at the lowest and also the value of company is at the highest. So for E4, the pecking order theory, the pecking order theory does not search for optimal capital structure. It is different from the other approach which discuss more on the advantages and disadvantages of optimal capital structure. So by following pecking order theory, they are following order that a company might follow, which is the first. The first is retained earning, and then the second is debt, whereby there are two branches, which is straight debt and convertible debt, and then lastly is equity, which is preference share and also ordinary share. So in this case, ATC Berhad will use all the retained earnings available first to finance the project, then issue the bond, as the debt will also finance the project. So ATC Berhad will prefer to issue bond over equity because debt has lower issue cost than equity that has higher issue cost. So the lower cost will lead to the higher value of a company.
The company should proceed with the new project if it gives higher and positive NPV. Why? It is because company will get profit as the cash inflow is greater than the cash outflow. What happens if the company get a negative NPV? Then the company will suffer loss. So based on the answer given just now, as the WACC is decreases from 13.17% to the 12.14% after the issue of new bond take place, then the NPV of the firm will increase. It is because with the lower WACC, the projected cash flows will be discounted at a lower rate. Therefore, this will increasing the NPV. Thus, the market value of the ATC Berhad also will be increases and shareholders' wealth can be maximized. Therefore, ATC Berhad should proceed with the new project as it gives higher NPV and positive NPV.
Last but not least, a conclusion for the entire issues in the question. For conclusion, as the primary financial objective is to maximize the shareholders' wealth, then companies should seek to minimize their WACC. In practical terms, this can be achieved by having some debt in the capital structure, since debt is relatively cheaper than equity, while avoiding the extreme of too little gearing or too much gearing. Companies should pursue sensible levels of gearing. Other than that, companies should be aware of the pecking order theory, which totally takes different approach and ignores the search for optimal capital structure. It suggests that when a company wants to raise finance, it does so in the following pecking order, which is first is retained earnings, then debt, and finally equity as a last result. That's all from us. Thank you for watching.